Good morning, everyone. Welcome to another glorious day of life. I hope the birds are singing to you. You are enjoying the sunshine today. You're going to love today's workshop, or I would say television show that we have ready for you today. If this is your first time with us, my name is Sadie Uribe, and I'm the media producer for Los Angeles Regional Small Business Development Center. The SBDC is a national program with over 1,000 locations across the country, helping to stimulate economic growth through business advising and development. We offer no cost services to the local businesses through funding provided by the U.S. Small Business Administration, SBA, and from the California Governor's Office of Business and Economic Development, GoBiz. The Los Angeles Regional Small Business Development Center network serves small businesses throughout Los Angeles, Santa Barbara, and Ventura counties. What we do? Well, we offer no cost business advising, meaning that you can meet one on one via phone or Zoom to address your specific needs and challenges. And we also offer virtual training and amazing television shows to help and adapt and grow your business. So, on that note, Lori, my goddess, how are you today?
Oh, you're awesome, Sadie. I'm doing great. Okay, everybody, like, can you believe it's the end of July? Is anybody else out there going, where in the world is the time going? I was just looking at the calendar for next month and the guest, I'm like, oh my God, it's already August. I cannot believe that. But welcome. I'm going to get immediately into what I'm going to talk about because I want to allot a lot of time for today's discussion. I have a very special show that I want to make sure we get to cover a lot of information. So let me just kind of run through this quickly. I've got my August webinars coming up, which Sadie will do the honor of getting all this in the chat so you can grab it from the chat. Now, next week, guys, remember if you're a frequent flyer, I did the Ask Lori Anything. I think it was like the beginning of July, somewhere around there. I don't recall. And we got a huge response saying we want more of the Ask Lori Anything. And at that time, I said, okay, guys, in August, I will throw in another Ask Lori Anything. So that is coming next week. Start to prepare your questions. You can put them in the chat, whatever you want to talk about. Like I said, every single topic is on the table. But I've got a three, four, five words. I don't know whether I want to call it a quote, a words, or whatever, but I'm going to create a foundation for maybe a topic that we'll discuss next week. So here's my thoughts after this week. And you know, I always have my thoughts of what I share during the Lori Talks by what I'm experiencing with the SBDC clients and the consultation. So this is my thoughts after so far this week, which is actually only 2 days. Passion is what gets you out of bed in the morning. Okay. Lots of times people say, oh, all you need to be an entrepreneur is passion. That's not true. Passion just gets you out of bed in the morning. Profits, on the other hand, profits is what buys a quart of milk. That's the important aspect. Now, I do really believe that it is always a great time to be an entrepreneur, as you guys that follow me a lot know, because I think being a small business allows you to do one of my things that I speak on, and that is take your power back. You're in control. You have your power. You've got flexibility. You can set your destiny and direction. And that's what caused me to become an entrepreneur at just 26, 27, is having, situations with companies not performing, going under, never knowing what was happening, and saying, hey, if there was going to be something financially and I wasn't going to be able to have a paycheck, I wanted to know ahead of time, not by some company announcing it. So I sought after that security in myself at that very young age. So I do think it's a great time to be an entrepreneur always, but it really is now because of the accessibility of the internet and tools. You don't need staffing, you don't need startup capital like you did many years ago. Okay. But I also believe it never feels great to be worried about money. Some of us have never had to be worried about money. Some of us worry about money more than others. I definitely have had times in my life when I worry about money, and I don't think it ever feels great to be worried about money. So I think we need to base our entrepreneurial dreams, goals, and actions on reality, on profits, on Passion will get us out of bed and give us some ideas, but we really need to make sure we have a full comprehension of our cost structure, where we are financially. Let's not get caught up in the entrepreneurship hype that's out there that says just go for it, just have some passion and jump out the door. So that's going to be my basis for my conversation next week. But you guys are also going to tell me what I'm going to be speaking about, as you did last time, by starting to put any kind of questions in the chat. And you're welcome to email me. Sadie always puts my email address in the chat. If there's a specific topic that I need to do a little bit of research on or something, or you want to make sure I mention it, send me a shout out next week and we'll get to it the following week. Okay. So with that, this is a really interesting show as well. I have a repeat guest that I'm so happy and honored that Nate will come on again. I've asked him many times. Nate Jemison has been providing access to capital, loan packaging, and small business technical assistant advising services for the Los Angeles SBDC Networks since 2008. I gotta say, Nate is the cornerstone of the access to capital program at the SBDC. I'm adding that part in because it's a true statement. Nate is an experienced business banker with over 20 years experience in commercial and corporate lending to corporate and middle market companies. Nate's a graduate of California State University, Long Beach, and has worked for Security Pacific National Bank, Union Bank, and Manufacturers Bank after graduating from the formal Security Pacific Bank Commercial Loan Training Program in 1982. He has owned a small business financial consulting business since 2001. One of the things that I personally always say about Nate is he knows what's going on in banking. Nate, you know it. And it was funny. First of all, welcome to the show. And Nate, it was funny as I was reading that, having the history being a banker as well. Isn't it interesting on my resume too, how many banks we're going to talk about that are no longer in existence?
Well, that's
I know.
definitely true.
I know, back in the days, you had them, banks were like cornerstones. They were there forever, right? And it's about 20 years ago, you're like, well, that used to be a community bank. That one's gone. That one's gone. That one's gone. There's so many that are not in existence. But today, Nate, I'm really happy to have you on the show once again. I wanted to be able to provide our audience with kind of a little bit of a dose of reality. I set us up even from my intro, right? I'm already getting us to speak about reality. But, even for myself, since COVID, I don't know what's going on in banking. And if that's changed, it made it harder, if people are getting money, what their options are. And some people have a lot of high hopes about access to capital that may not be really true. So that was part of what we wanted to discuss. Now, I know that you have a PowerPoint presentation that you can go through that gives us kind of a foundational understanding on topics that are also important to know. Do you want to start off by sharing the screen and going through that? So we'll start with a little bit of banking education here before we launch off.
Yeah, that'll be my preference, to share with you guys the importance of how to apply for a loan, and it kind of covers the things that are, I think, the topics of discussion today relative to the types of funding that's available. I know a lot of people have been preferring to try to get grants.
Yeah.
Grants are not really a normal way of financing your business. Grants do not really cover the amount of funding that your business might require to either start or grow. They might provide like some type of financing for you to do the real small things. Grants rarely go beyond like a $5,000 grant amount. So that's not really probably enough capital for you to grow your business. And also,
Nate, you never heard, before COVID, unless you had some specialty research project you were doing, or some kind of urban community project that has grants, you never heard of people even getting grants to start up companies. So people have to get that connection of startups and grants. In my opinion, I'm going to ask your opinion on this, kind of out of their mind, because that was situational, because those grants were funded by Congress, which is
Mhm.
a whole nother animal. And I also tell people that when you apply for a grant outside of, that situation, a lot of times they want heavy proven track records and financials because it's part of the requirement to get the grant money. So there are the 5,000 here or there, but that's not the norm. And I think eventually those will dissipate as well. Your thoughts? I know you're going in your presentation, but while you mention it, your thoughts
Well,
on that?
we could spend a few minutes on grants. Grants were originally intended for nonprofit entities because the grantor, the person that sponsors the grants, normally will look for some kind of public benefit where they can really benefit from contributing money, like you have the AIDS Healthcare Foundation, for example.
Right.
They raise a lot of money and they provide funding for different aid service providers. And that's kind of the benefit that they get, that they attract money from like major corporations, Nissan, Tesla, whatever major Bank of America might give money for these foundations to give out grants to, their service providers. So that's the true spirit of how grants are basically generated. Now, there are grants for, just like you mentioned, Lori, for major research projects, like if you have a cure for cancer or something like that. But the grant funding comes from primarily the corporation, the private or benefactors, individuals with money, celebrities and people like that. They donate their money to create grants for people to provide services that are public benefit. So, in return, they kind of get like some publicity around it.
Right.
But because of the COVID and disaster related situations, the government got involved in issuing grants, but normally you have to compete for those grant funds as well. And that's why the amount of grants are kind of limited. The amount of money that's available is limited, especially for for-profit businesses. That's why they kind of have those $5,000, $1,000 limits. For example, if you wanted to open a business in a city might be incentivized to give you a grant available from that city, but the amount would be maybe just for cosmetic painting and things like that, for you to lease a property in their city and things like that. So you really want to think about financing for your business, to grow your business or to start a business. You really need to think more about loans, or if you don't have the private equity yourself to invest in it. So those are the kind of things we can kind of talk about and even ask questions about later, if you like.
Absolutely. Yep. Let's go for our beginning learning. And in the olden days, we always said that people need to get funding from friends, family, and fools. That's where startup capital came from.
That's right. Absolutely. So like with that, I guess I can share my screen.
Yep, you should be able to. If you can't, you let me know, but you should be able to.
Okay, hold on
Yep,
one
you
second.
can.
Let
Perfect.
me get it up.
Yep.
Let me see here. Does everybody see that? A
Yep,
business loan?
you're good, Nate. Take it away. Guys, this
Okay,
is
so
good education. Let's sit back
all
and
right. So let's talk about business loans. And in this presentation, what you're going to learn about is applying for funding. So we're going to cover things of like the types of loans that are available, what's required, what might be the right bank for you, because there are banks that have specific priorities for the industries that they want to support. And where do you go to get help? And that's primarily the SBDC, us, and we'll talk about like next steps. Okay, so the first thing, you want to be aware of the types of loans that are available. So whether if you're starting a business, or if you have an existing business that you want to grow, you might need some additional equipment, you might need to hire employees. There are various types of loans that can be available for you to do that. And right now, the lending environment is they're looking for good clients, good customers, good loan applicants, because after the COVID-19 pandemic, it created a lot of barriers for applicants to apply for funding, because their businesses either suffered as a result of COVID-19, the increased costs and things like that. A lot of businesses have not quite recovered. A lot of them have went out of business, unfortunately, after getting some disaster relief financing. So that creates an atmosphere for a bank or any other lender to kind of hold back, and they don't want to take as much risk. So it's been a more complicated and more a lengthy process for loans to get approved. So let's talk about a traditional loan. A traditional loan is like whenever you have a request to finance your business, you go into your bank. Hopefully you have a bank of account that you have a business checking account. That's one of the first things I ask our business clients from the SBDC to make sure they open this business checking account in the name of the business. Okay, that's the primary thing you really want to do. Okay, you want to have a business checking account, not your own personal account, but a business account in the name of your business. So if you open a bank account at a certain bank, you probably want to go to that bank first, talk to them about if they have business loans available. Because a traditional loan would be probably the most affordable loan, using the prime rate with maybe a little spread. The prime rate is what we call the Wall Street Journal like prime rate, the cost of funds rate plus 2 points. I don't want to get too deep in that discussion, but the traditional loan will probably be the cheapest form of bank or business financing that you might be able to afford.
Nate,
So a
before we
traditional
leave
loan, yes,
traditional,
what?
yeah, before we leave, can you also mention, because I get this all the time and it was just yesterday, people do not realize that when they are applying, the credit checks and the financing and the collateral and everything is based on your personal. They think,
Mhm.
well, the business is the one that's borrowing and it's the business history and the business. Explain to them how it really is a
That's
personal credit check for a business loan.
if your business has not been in existence for more than, say, 5 years, you probably don't have much of a business credit profile. But always, whenever you're applying for funding, a lender is going to probably look to ask for a personal guarantee from you. So normally that's going to require them pull your personal credit and things like that. So no lender is going to give you a business loan based on just the credit history of the business. If the business is not has not been around for several years, where the lender does not have enough financial statement data that reflects a very strong company. Normally, a lot of times, a business, if you're new to the lender, they're going to want you to provide a personal guarantee. So the first thing they look at is your individual credit to see if you've been managing your credit responsibly. A lot of banks do have like a minimum credit score requirement. So if your personal credit report is like below 600, you're probably not going to get approved for a loan. So I'll kind of talk about some of those things as we kind of go through this presentation. But yes, because of most lenders have a policy where they want you to personally guarantee the loan, they're going to want to look at your individual credit as well as your individual resume, submit a personal financial statement. I'm going to kind of go through those things through this presentation. But the types of loans are a traditional loan. That's if you need some business equipment, you want to hire some people, you go into your banker, you talk to them about that. I say banker a lot because also a traditional bank could be just like your B of A's, US banks. There's some good banks that have good small business loan programs, but there's also this group of lenders that's called like Certified Development Financial Institutions, CDFIs, and they have like small business loan programs, but they don't require like a depository or you to have a deposit or checking account. So that's a source of a funding source for you to use if you don't quite have a business checking account, although you still should. They're going to encourage you to open one somewhere, but they don't necessarily need you to have a business account for them to make a loan to you. Okay, because see, sometimes you go to a traditional bank, you might have just started your business, you might have not be a major depositor there, and they might not qualify you for a loan, but they will probably have a CDFI lending partner that they can refer you to get a loan from them. And that's where you normally roll into the SBA loan programs. 7A loan programs, which is basically for any business purpose for a loan. It could be anywhere from $5,000 micro type loan up to $5 million you could borrow. Okay. 504 loans are basically related to commercial real estate acquisitions or refinances, or for large equipment acquisitions that might be like over $250,000. So that's like a 504 program, which is a really nice program. So if you're under the SBA 504 program, if you're looking to buy like a commercial real estate property, say it's $1 million, the only amount of investment you're required or the amount of money you're required to put down for that property is 10%. So if it's $1 million property, you'd be asked to put down 10% of the money. That means you'd have to have $100,000. The SBA would support 40%, so they would provide a loan for $400,000. And one of the SBA's lending resource partner, a traditional bank, would put 50% of the money in 500,000. So if you got $1 million transaction under the 504 loan program, you'll be required to put down 10%. The SBA would finance 400,000, and a traditional bank partner would finance 500,000. So it's a very attractive program, very popular program.
Yeah, and
Another
one
way,
thing I always like to point out is that's why the SBA loans are easier to get often than a traditional loan, because if you think about it, the government is being the guarantor to the bank, allowing them to loan to situations that they may not have on their own. So I always explain that
right.
to people so they can see, because they think there's a pot of funds called the SBA funds, and it's not.
No,
It's just that they're
no.
guaranteeing the loans, and that's what makes SBA loans attractive to small companies, allowing them to get access to capital and lower interest rates they would not traditionally be able to.
Like I mentioned earlier, under a traditional loan, if the bank's policy is to do only finance individuals who have like a credit score of 650 or 600 and above, that doesn't mean you can't get financing. What it means is they might require that credit enhancement of getting the SBA guarantee for them to make the loan. So in the case of like a 504 loan, that's kind of a direct funded loan from the SBA through a bond issue, but also they have to have a bank partner. A bank partner might not feel real comfortable giving this person a regular traditional commercial real estate loan because of the credit score. So they might say, hey, we could probably do this as a 504 loan because that way we got the SBA to fund part of it.
Yep.
We'll give you 50% because normally a commercial real estate loan from a traditional bank commercial real estate loan, they would require you to put 20 or 25% down, and they would only finance 75% of the acquisition. So under the 504 program, their limit is 50%, and the SBA steps in and does 40%, and you only have to put 10% down.
Yeah.
So you can see the benefit, and that's why it's really attractive for a lot of small business lenders or a lot of small business loan applicants. Now, a line of credit, so it's a summary, the SBA is a credit enhancement to support a bank loan made to you where you have some risks that the bank can't take. It might not only be the credit score, it may be that your cash flow or your history and operations are not satisfactory, because a lot of times a traditional bank loan wants you to be in business at least 3 years.
Yeah.
But say if you've only been in business a year and a half, your business is very, very successful, they might not feel comfortable because they want you to have that 3 or 4 year experience. So they'll ask you or offer you, maybe let's do this as an SBA loan. And in that case, you definitely will be required to guarantee the loan.
Yep.
So,
Yeah.
That's kind of where they look at the credit score and all those kind of things. Now, a line of credit could be a method of financing your business primarily for operating capital. In other words, you don't want to buy a lot of equipment using a line of credit, because a line of credit is really intended to support operating expenses where you pay down the line of credit at least maybe every month a little bit, or actually during the year. You need to make principal reductions on a line of credit. It's not meant for you to buy fixed assets and things like that, like cars and things like that, but a line of credit is going to have an outstanding balance, for 2 or 3 years. That's at the limit. So you want to make sure you revolve that line of credit. Most lenders require you maybe to be out of debt on your line of credit for a period of time, 5 days up to 30 days in a row. They want you to be able to demonstrate that you can do that. Now, a line of credit, a lot of times at traditional banks, depending upon what you're looking for, they might give you a business credit card, because some banks could give you a business credit card up to $150,000. So depending upon what you need the money for, it might be a good solution for your financing problems or issues for you to get a line of credit or a business credit card. But, it'll probably have a more expensive interest rate, like around 12 to 15, or maybe in some cases 30%. But there is a lending product also that's out there that I'm going to talk to you probably about at the end of this types of loans that are available. Microloans are loans that normally go from up to $25,000. The SBA has a microloan program that that's provided through CDFI type entities, but some banks have their own microloan program. That might be any loan below $25,000 or $50,000 in some cases that require less documentation. It's basically credit score driven, So if you have like a credit score over 700, you might walk into a bank like US Bank. I know they used to give for anybody with credit scores above 680, you can probably get like a $50,000 line of credit or credit card as long as your credit score is above 680. So they do have those kind of programs. You just want to be aware of those. But a
And they don't
micro,
require collateral, right? So those type of microloans, you do not, they're unsecured without collateral, and that's another advantage. Am I correct? Is that still true?
that's very true.
Okay.
However, I will tell you this: in all cases, or most cases, when you have a business, the bank does complete what they loans below 25,000. They probably won't even do a UCC one, but loans over 25,000, they might still file a lien on the business assets, which can be like a blanket collateral, a lien. What that means is they do a UCC one filing with the state, the Secretary of State, and it protects the bank in case you default on the loan or you go out of business. That lender will show up as having priority on the assets in case of a default or in case of a liquidation of the business. So those liens have to be satisfied. And before any other lender gives you money, they're going to want to know about if there's any other UCC1 filings on the business, because that lender will have priority on the business assets. So they might ask that lender, they will in most cases pay it off as a result for them to give you additional money. So they'll be in first position. It's all
Now,
about
Nate,
being
that
first.
begs the question of the COVID, idle loan, obviously, because UCC filings is on 25,000 or above. And these are these things that are coming to the surface now that weren't thought of prior. Are you seeing conflicts with people trying to get microloans with the UCC filing with the idle loans?
Yeah. But the good thing is, and it's a matter of processing because of personnel shortages and things. The SBA is always willing to subordinate their lien to any new funding that you might apply for, because they don't want to stand in the way of interrupting your business. In other words, if they can't do it, if your SBA lender can't do it, whoever you went to originally, if they decline you, the SBA is willing to subordinate their lane to go in a second or third or fourth position, in support of you getting new funding from another lender.
And you don't have to pay them down with that
and
new
you don't
funding.
have to pay them down.
Awesome. Good to know, Nate. That's very good, because we get questions about
It
that a
just
lot.
takes a little while with the SBA.
Yeah, I understand what you're saying, but they will. So thank you. That's good to know.
Yeah, they basically adopted that policy now, because they used to have a policy where we might do it, we'll consider it, but now they'll do it all pretty much automatically. It just takes a little while to process, but they'd be willing to do that. So credit cards, get a business credit card if you can. A lot of times when you open up your business checking account, a lot of lenders, banks will offer you a business credit card. It might be a very small amount, but that would be probably a good way for you to start building your business credit profile. So that's kind of one way to start building that. And normally after 6 months or so, they might look to increase your credit card limit and things like that. And also, if you've had, like, say you got a real poor credit score individually, you can always open up a checking account, say with $2,000 or something like that, and have your credit card be a cash secured card for $500, just to try to get the process started. And normally, I normally don't recommend people starting a business using credit cards, especially their personal credit, because we see a lot of that happening. And your credit score is impacted by your usage on your credit card if it doesn't have a lot of availability on it. So I get a lot of requests with people coming in looking to start a business, and they've been funding that business with their credit cards for over a year or two, and normally their credit limits are at the max, and then it draws down their credit score. And to get that, and sometimes they want that debt refinanced with a new business loan. But they say, "Oh, I've been using my credit cards." A lot of lenders don't want to do it. They don't
I
want to
saw
get
a
engaged.
I saw a stat, Nate, that 82% of the small companies are funded with credit cards. That's a very high number.
That's very high, very
Yeah.
high. And it's, so I always tell people, go in to try to get a business startup loan. If not from your traditional bank, go to a CDFI. Most traditional banks have CDFI relationships because they always want to have some place where they can send their clients that they can't support. So most banks will have a relationship with a CDFI lender who will be willing to take more of a risk to give you a business startup loan, at an affordable rate, okay, but with the SBA guarantee, okay, because the SBA does have limitations on the amount that the SBA should charge you as far as interest. It's normally capped at, like, say, prime. Prime today is 8.5%, and they could probably go as high as like 5% over that. So the one thing I want you all to try to avoid is those MCA, merchant cash advance
yes.
loans. A lot of people get in trouble because it's easy money that comes quickly, where they can improve you, say, like in 48 hours or something like that, cash. You see the advertisements all the time. You need to avoid those transactions if you can. If you can't afford to pay those transactions off, like, say, within 6 months from your business cash flow, I would definitely discourage you from doing that, because you'll get caught in what I like to call the hamster wheel of lending, because they'll offer you more money after 6 months, whatever period of time that loan is scheduled to mature, but they're going to get more fees, and they're going to continue to charge you a higher rate of interest. And it's not going to allow you to really grow your business, because your cash is going out, if not daily, it's going out weekly or bi-weekly. Just not really recommended.
And Nate, what you're talking about is so important. I see a lot. Can we take one step of clarification that we are not just talking about those buildings people see that says payday loans? We're talking
Mhm.
about things like, I forget which companies, but you've
There's a
got
lot.
some of the online payment companies are offering them. In other words, these are disguised under even the portals that you're selling
Instant
your
credit,
product.
yeah,
Is what
a
I'm
lot
trying
of,
to say.
yeah, because it's unfortunate. Now I know, like, the SBA has a lender match portal, but a lot of those guys are even in those lender match portals available from the SBA, and that's kind of sad. But so the main thing is this, and I'm going to talk about, like, what's required for a loan. I think it's going to be the next section. Um, if any lender asks you to provide your bank statements, like 3 months bank statements, and maybe fill out another application form, and that's all, that
Yeah.
means that they're looking for your deposit activity to see how much they can pull from your accounts every day or month or whatever the structure of that term is. That's the red flag, because most lenders are going to ask for bank statements eventually, maybe 3 months worth. But the first thing these guys ask for, those alternative lenders, MCA guys, they want to see what kind of activity money goes in and out of your bank account every month or week or whatever, so they can determine how much money you can apply for, or that you'd be eligible for, and how they're going to charge your accounts, whether it's daily, weekly, or whatever. So let that be a red sign. Factoring is very interesting. Factoring is a way to finance a growing business where they support financing your accounts receivable. So say you are selling your product to a local boutiques and stores like that, and they're paying cash. Your customers will pay you cash, or maybe pay you on short terms. And then all of a sudden, a large retailer comes along and they want to buy your products in bulk. So in other words, you go from a $100,000 a year in revenue to maybe 500,000 or $1 million because of this new customer. Say Macy's is calling you, and they want to buy your perfume that you might be selling. That's a classic case where you want to get a factoring first, because they will basically loan you the money based on the quality of your customer that you're selling to. So they'll take those invoices or those purchase orders, and they will give you 80%, up to 80%, as soon as you provide them the invoice, allowing you to buy your supplies and build up and things like that to sell a product. The only thing is, you got to remember about factoring. There might be some controls that the factor might require, that the Macy's send you the invoice or send them the invoice, and they'll distribute your money after they collect the invoice. So sometimes that can kind of create a problem. But any company that's thinking about growing rapidly by taking on a large account, factoring might be the way to do it. Now, factoring is kind of very popular right now because a lot of companies are coming out of the COVID crises, and a lot of companies are seeing that the factoring is there and willing to step in, whereas the banks, because of their policies and things like that, and licking their wounds from the COVID financing situation, the factor is providing a nice place for a lot of companies to kind of get back up on their feet. However, when the SBA is involved and they still have that UCC1, again, the SBA is allowing the factors to come in and take priority liens on those, but it's just a timing issue. It takes a little while to kind of get the SBA to do that. So I'm going to go on to the next page. Anybody, or do you have any other questions?
Yeah,
about
and
any
I'm
of that?
answering some as people were going by. I've been answering them.
Okay.
But one thing I didn't know is how long after a loan's been paid does it take for a UCC filing one to remove from the
Oh,
I don't know. I know
Yes.
that varies.
It's not done automatically. Unfortunately, at major banks, it's mostly done automatically. But some lenders take their time. They wait to kind of for the client actually to get in contact with them. It's unfortunate, but some banks are structured to where they'll release the UCC filing, and normally they will do it right away once they're aware that you submitted it. So what you would need to do is submit it like a UCC3, a release form, eventually for them to release it, release that lien. And they normally do those automatically when a loan is paid off. But sometimes again it's internal, depending upon how they're structured. They might take a little while to get it done, but it could be done as soon as like you pay off the loan, maybe wait a couple of days and say, hey, I want my lien release, and they'll probably do it internally. They have to send the document. They basically send the document themselves. It doesn't really require your signature for a release. So
And then,
it can be done quickly.
two other things that I wanted to run by is I had a couple questions that I answered, but I want to make an announcement. People asking what kind of loan for this situation, what. Nate, I told them to do a shout out to you that you were one of the team members on the Access to Capital team at the SBDC. We'll sit down and talk with them about their circumstances because usage of funds I was explaining to
Yes.
it was. So I just want to do a shout out to everybody in the audience that Nate's one of us at the SBDC. He's got a whole team. You can sit down and talk, or sit down, I should say, give them a call and have a phone conversation, a Zoom call where they're going to go over your circumstances, look at your numbers with you. So that's a huge resource. And the only other thing I wanted to add, Nate, is we were talking about the different interest rates, and me being the CFO, you
Sure.
got budget in these costs for the interest rates. People get these factoring amounts and what have you, and they don't think of the cost of capital in as the profits they have to look at. That's a loss of profit. So you have to also budget and account for this in your selling price for the cost of capital. And people don't even think to do that. So I just wanted, that was my own personal thing I wanted to mention.
Yeah, no problem. And that's very correct. You need to, one of the things we do at the SBDC, we have you do a monthly projection form. And normally those kind of costs of financing costs would be included in that projection, especially if you're thinking about financing an expansion of your business or some growth, or if you're a new business, you need to add the finance costs in those projections. So I'll kind of talk about that briefly, but requirements for a loan. This talks about a personal financial statement. These are the things you would need to have as part of a loan package. You might not be asked to provide all these things up front, but eventually these things will likely be required, especially like in the case if you're a startup business or your business is you're seeking financing to expand your business. They like to know a little bit about the business plan, okay? So you need to be able to express in a business plan what it is you're looking to try to do, what kind of research you've completed. And this will incorporate actually projections, I think, which was added to the second page. But the first thing, personal financial statement. They're going to want to see a personal financial statement, see what kind of assets you might own, for them to make a determination and analysis to see what kind of guarantor you might be. A resume, a lot of lenders will ask for that. And when I say lenders, I'm talking about banks, CDFIs, and other lending resources. So they kind of want to just have a background and make sure that you have some kind of experience that relates to your business, or if it's like transferable skills or things like that, if it's a startup. So they want to know that. Business plan is very important. Again, for a startup, all startups, SBA kind of requires a business plan for all startup businesses. But if you're thinking about, even for like a non-SBA loan, if you're thinking about getting a traditional bank loan for like a expansion purposes, or if you're going to open a second location and things like that. Now, normally, if you're going to invest in a franchise, I would say your business plan is going to be the franchise should help you craft a business plan, because again, if you're going to invest in a franchise, they're going to probably have controls or certain requirements for you to open up a controls relative to what location or area you're going to be operating a franchise. So that's something you'll probably work with to prepare a business plan if you're going to be investing in a franchise. A personal credit report, we talked about that. It's very important. It's kind of one of the 5 important C's. So look on your character to see how you manage your credit. That's kind of gives the lender an opportunity to see that. Tax returns, definitely want to see your tax returns. If you have an existing business, it should say business tax returns. They put corporate, I need to probably change that. But business tax returns and your personal tax returns. A lot of lenders like to see the last 3 years, but some go with the last 2 years. So if you want to make sure your 2023s are done, where we're in August now, almost August. If they saw an extension, that's fine. You need to be prepared to provide them with a copy of the extension of the tax return for 2023. But you got to have 2022 and 2021. Please have your tax returns done. I know people, because it was COVID, they're still kind of late. But if you don't have like 2022 or 2021 done yet, that reflects on your character. They're saying you're not taking care of your business. You should have your tax returns done. So make sure you have your tax returns done at least through 2022. And if you have a 2023 extension, make sure you have that extension document. Okay. Financial statements, they're going to want to see a balance sheet and income statement, not necessarily a cash flow, but if you can prepare the cash flow using certain accounting software like Lori might have available for you, that would be nice. Okay. But normally the income statement and balance sheet are definitely required. And now that we are in like 6 months into the 2024 year, you're definitely going to want to have an interim 2024 income statement and balance sheet prepared for an existing business. Again, if you're new, you're not going to have those kind of things. They might ask you for an opening balance sheet for a startup business. But the income statement, if you're not generating any revenue or anything like that yet, you have just starting a business, you're not going to have that. But an opening balance sheet, they would probably want to see for a new business, a startup business.
And Nate, let's talk about that for a second, because this is where a lot of our clients get messed up with. And I want to have 2 things talked about a little bit here. Is some people are not utilizing accounting software and therefore cannot run a balance sheet, but you can produce, which I do for people. It's not the easiest, but we produce with the original data a balance sheet that's properly set up presentation wise, and you put it in a PDF and the banks will accept that as well. It doesn't have to be the software. It's preferred. But then the other thing I think that's maybe even more important is have somebody, if you don't understand how to read the balance sheet, look at it. And this is where the SBDC Act team is really instrumental, because I'm telling you, this is a Lori number, Nate, a Lori number just from experience with it. But I swear about 92% of the people's QuickBooks accounts are not right. There's balance sheet accounts that are off. And you mentioned the word character, and guys, that word character is not a word Nate uses. That's the word the banks use. You just show these documents and they can see, like a banker, like I can look at the documents and go, okay, something's wrong in their internal accounting. It's a character flaw, and it's really hard to back into good ground again. So having someone look at these documents before you send them off, if you don't have somebody internally, is really key. Your thoughts on that, Nate?
Oh, absolutely. That's why, at the SBDC, we asked you to prepare a loan document package. And then and it basically consists of all these documents. And some people say, oh, that's too many documents. It's too many. Well, the reason we ask you to kind of prepare these things so we can review them with you together. And, during that process, we will see, oh, this should be a long-term asset, not a short-term asset. So because a lender will look at that and they will say, I'm not wasting my time here. They don't have that kind of time. So they would either reject you straight out, unsatisfactory financial reporting. So you want to make sure that you're making sure your accounts are correct. Some of you I know, especially small business entrepreneurs, you basically at the end of the year, you give all the information to your accountant. And unfortunately, some accountants are not the most solid people producing, especially a balance sheet. So
I know. No, they're not.
Yeah. So, and if it's bad information going in, like Gloria is saying, using whatever accounting software you have, it's gonna, bad information is gonna come out. And we see that all the time. So you want to make sure your accounting is accurate to the best of your ability. Everybody can't afford a CPA or accountant, but you can always have the SBDC, which no cost services and support. So that's why we ask to review this kind of information, because we're not going to want to send you to a lender where we know the application is going to be denied because it's poor financial reporting quality. Yeah, so that's very important.
You know,
Very,
it's no different than clean your house up and put some paint on it before you put it on the market to sell. You know, it's the same thing, you know, do the
That's
house
right.
cleaning to make sure it looks right before you put it on the market.
That's right. So the last thing I'll say about the financial statements, most lenders will consider any financial statement more than 90 days old to be stale. So right now, we're almost getting into August. So if you provided a financial statement tomorrow that's dated 4/30, 90 days from then it's 7/30. So that statement will be, financial statement will be considered stale. You might as well start preparing your 5/31 financial statements. You know, 6/30 would be better. 7/30 would be great. That would be, this guy is on top of it.
Yeah.
Right? There you go. They got probably a good accounting system. They can produce a financial statement within a day. That would be best. And that kind of like goes a long way in that loan process is, okay, these people have it together. So think about that. But if you don't have anything since December 2031, 23, you're gonna say, wow, okay, do you know how much money you made? So those kind of things just bring up questions. You know, they might have questions relative to that. So I'm gonna go on here.
Yeah,
The
and it goes
financial,
back to what you said, Nate. You should look for money before you need it at the beginning rather than when you need it, because it's harder to get then. You know, this is something you
yeah,
prepare in advance for.
prepare in advance. So again, requirements for a loan. I have the word collateral here. Now, collateral is basically, they're going to take a UCC filing on your business in most cases. In some cases, depending upon the amount of money that you're going to borrow and the use of the money will dictate what the collateral might be. For example, if you're going to buy a truck, a commercial truck, you buy commercial real estate, that's going to be your collateral naturally. But if you're looking for working capital money, like just to hire some people or to maybe inventory would like be the collateral, but they're still going to be looking probably for some additional collateral. And that's why they look at sometimes at your personal financial statement to see if you own a home, to see if that home has some equity in it, because that might get you closer to a yes, as opposed to not owning a home and asking for a lot of money that's going to support operating capital, which doesn't really have a whole lot of collateral value for them. They'll just rely on the UCC filing on the business itself, which means all the business assets that are owned by the business. And, you know, so, but having collateral support, that would be something that a lender is going to analyze. And depending upon the amount of money and the use of the money, it might not be as important for them to like have you pledge your property. Now, one thing I will say to people, I always tell people, don't pledge your property if you don't have to. If they ask for it, if they ask for it, fine. If you can't give it though, you can't give it, because the SBA normally will not require any real estate collateral if it's not available. Now, a lot of lenders, they'll take that as a reason to tell you no, though, you know. But the SBA really does not require real estate collateral to be pledged in all situations. But they always want the lender to ask for it. But if it's not available, it's not available. And the lender will have to make that decision, and the SBA will have to make that decision based on other factors, which there could be other factors. It's just that a lot of lenders are kind of lazy in this regard. They said, oh, if they got some real estate collateral, let's get it. You know, just let's get it. We'll at least have a house
A sure bet
to
then. It's
fall
a sure
back on. Yeah.
Yeah, and Nate, this kind of feeds into a question that Kim had in a way. What they are looking for is what we call cash flow, that you have enough money to pay the loan. So sometimes when people invest their money into a company and then they're not making much money, then
Mhm.
they will get turned down because the lender wants to know where are the funds coming from for you to pay this back. And therefore, having a 401 is not going to give them comfort. They want to see cash flow coming in to pay. And I'm kind of restating Kim's question a bit to comment on that and have people understand how important it is for you to be able to have cash coming in to show them that you can make the payments.
You definitely want your business. The primary source of repayment is the business.
Yeah.
That's the primary. They don't really want, and I think in most cases they can't even take your 401ks and stuff as collateral. They're
Nope, they
forbidden
can't.
from doing that. So although you might have cash available through your retirement and all those kind of things, that's great, but they can't take that into the loan consideration. They got to strictly look at the business cash flow. And if there's other collateral available from you that you're willing to pledge personally, like I said, the real estate equity in your home. Let me just tell you a real quick story. I had a guy who was he had owned a restaurant, a deli, and he was looking for like $80,000. And when the banker looked at his personal financial statement, I'm going to go back up here, personal financial statement, he noticed the guy had classic cars valued at $150,000. You know, he had two classic cars that had a value of $150,000. The lender, happened to be a classic car enthusiast.
Okay.
Said,
Okay. I was going to say, otherwise they wouldn't look at that.
I don't even want your business. I won't even do a lien on your business. Just give me the liens to those two cars.
Because he knew they had the value. He was comfortable with it. Gotcha.
Right. So those are the kind of things that the lender likes to see. That's why they want to look at your personal financial statement, et cetera. You know, they want to see what kind of assets you might have to kind of make this deal happen. Well, that deal was done in a week. So,
and you know what was interesting when I first got into banking and people were talking about like a bank appetite and a lender appetite, I thought they were saying like what we were going to eat at lunchtime. You know, I was like, why are we talking about a bank appetite? Where do you want to go eat lunch? I didn't know, right? And so a lot of people don't realize that decisions in banks are made depending on the risk that the bank feels. Like if they just got you know, a bunch of default on a bunch of loans that were of a certain, like an agricultural on corn, they don't want any more agricultural corn. If they got too much real estate, they don't want real estate. So this appetite is what they have a comfort absorbing in risk. And I always tell people too, you got to remember banks are lending out your deposits. So there is a fiduciary responsibility that the government oversees on them lending out, you know, your deposits.
Let me say this real quick, and I'm going to go right to that point. So I'm going back to the requirements for a loan. So you have to be a legal business. Obviously, they're going to want to see your articles of incorporation. And if you're a franchise agreement, if you have a commercial lease, that's kind of important because the bank is going to want to give you a loan that does not exceed the term of your lease. So if you've got a 5-year loan, they're going to want you to have a lease in place that at least has a 5-year option if it's going to be expiring within 5 years. So those are just a couple of things I want you guys to be aware of, but we will kind of go over those kind of things if you get in contact with me and want to get some advice. Financial projections, we kind of talked about that, but so those are going to be required anytime you're going to be starting a new business, you're going to be thinking about expanding your business. So you want to have financial projections available. Now, this kind of goes to what you're just talking about, Lloyd. How do you choose a bank?
Yeah,
right?
Yeah, it does.
Which banks offer the best loans? Well, both of those questions are basically tied into the same thing. What risks, what industries does a bank support? Like Manufacturers Bank, downtown LA, they're heavy in the garment district. They love garment business. Their Citibank used to do a lot of entertainment. So some banks have sweet spots for certain things. But I can tell you right now, most of the lenders are cool right now on restaurant-related businesses because a lot of them got scarred during COVID.
Yeah, I can see that. Yep.
Yeah. So if you're going to go in, if you have a restaurant and you look for finance, you got to make sure all that documentation is pretty solid. You got a solid state of financial projections with good assumptions. So a lot of lenders are leaning heavily on your financial projections, which is this item here, financial projections, to make lending decisions because they're looking for a solid set of projections. So if you lost money, say in the last 2 years, and you know, a lot of people blame it on COVID, supply chain issues, and things like that, you can still get money, but you're going to need to prepare a monthly financial projection and have a good plan with assumptions, well explained, to get the money. So like right now, I'm going to put this name out here. I'm going to use it right now because right now Chase Bank is really aggressively out there in the marketplace. They're not doing as many business startups, but they have a lot of good small loan programs. They're having a program too where you can get like mostly the credit cards to help start your business and your business name. U.S. Bank has always been pretty solid too. So I'm just going to throw those two names out there. If you have an existing banking relationship, either Chase or U.S. Bank, you want to talk to their small business lender if you're a small business. So I'm just going to use those two names right now. But what you need to know, actually, too, no bank is going to give you 100% of what it is you're looking for in most cases, especially if you're a startup. You need to be prepared to invest your money, like at least 20% minimum is kind of standard. But with SBA support, it can go down to as low as 10%. That's another way a lender might use the SBA. If they see that you don't have the 20% that might be required to do that $100,000 expansion project for working capital, they might do it as an SBA 7A loan where you only had to put down 10%. So that's how the SBA is kind of used, like I was saying earlier, to support any loan application that a bank might not be able to do under their traditional loans. How fast can you get a loan? That's always a good question. Again, avoid the 48-hour turnaround, money in your pocket loan. I do have some lenders that could probably get from the time you submit a complete application, and I say that because you might have an online application. That's not the complete application. They're going to have a follow-up email to you asking for all the kind of stuff that I was talking about here. What's required? They're going to ask you for those kind of documents. But now on the initial application, they'll have an answer for you. Oh, yes, we'd like to give you money. And a lot of times it's going to be based on your individual credit and maybe just a 1-year financial statement for the business got to show a profit. But then they'll ask you for all those other documents eventually to make you an affordable loan. Whereas the other guys, they'll ask you for your 3 months bank statements and maybe 1 year financial statement. You fill out an application and they'll give money to you in 48 hours and you'll be paying 60%.
Oh, and you won't even know it because
you won't even know it.
And they don't give you an interest. From an accounting perspective, I've tried to back that information out. Even with my knowledge, it's hard to back that information out because it's hidden because they take it out of the sales. So yeah. And going back to that personally invest, like they always say in banking, they want to make sure the entrepreneur has skin in the game as well. So a lot of entrepreneurs think that, oh, I don't want to use any of my money. I'm just going to get a loan. They have to understand, no, they want you to have skin in the game.
You have to have skin in the game. And if I have more time, I kind of explain to you the reason why. Well, let me try to explain anyway. If, for example, banks have a risk requirement, they have to have reserves and all those kind of things for risky loans. But they like to keep the debt to worth ratio at 4-to-1. So for every dollar that they give you, they want you to have 20 cents invested, and actually $1.20 invested, so they can keep that leverage to 4-to-1. That would be more like a 5-to-1 ratio, but that's kind of the maximum that they want to operate with. That's why they can't give you 100%. That means that they'll be doing 100% financing. The last thing I want to say, what can the money be used for? Very important. If you're going to buy a truck, if you're going to add people, well, a truck loan will be better structured as a term loan. Okay. If you want to operating capital, support employees and things like that, that could be a line of credit. So understanding what you're going to want to use the money for is very key. A lot of times people come into a bank, they say, well, how much can I qualify for? They don't want to hear that. No. In other words, give me as much as you can, give me the Brinks truck, $1 million. I can use that. You can't, right? So you need to know, what are you specifically going to use the money for? Well, I want to hire this many people over this period of time. These are their salaries. I need to get some office equipment. That's this much. Have a breakdown, a list of how you're going to use the money. I always tell people, if I came into your business and I had a sack of cash and you asked me for a certain amount of money, I'm going to say first, show me how you're going to use this money. So think about that and make sure you're ready for that. Okay.
That's key. Usage of funds. It's a key term. And that's why I was writing to Chris. It's usage of funds on that. Well, Nate, thank you so much. Oh, by the way, there is the character.
There's the 5 C's.
5 C's. That's what you learned that on the first day of banking training. I remember that.
Cash flow, character, personal cash injection. So these are like the 5 C's. So again, I'd go over everything with any of your clients. I'll come back or some other time. But
And I'm
those
gonna
these
want
five
you
keys
to
are
actually, Nate, because you are just great. Thank you for coming and giving us a formal presentation, guys. I just wanted you to have an understanding of the mechanics involved in getting loans, because too many times with these quick payday loans, people don't realize the intensity of the process. I also wanted them to be aware of the access to capital team and how you guys are on the client side communicating with the lender, but helping them to prepare. It's a great asset. And Nate, he heads up the access to team. And so getting us to have you on for a whole hour has been an honor and a privilege. Thank you for sharing all your information.
okay. I'm gonna drop my my in the
Oh,
chat.
your email has been in the chat so many times, Nate, you're going to kill me.
Oh,
We have a ton of people emailing you. Yes. Sadie started
okay.
at the very beginning. Everybody's got your email. Believe me, you're going to
Oh,
get them.
okay.
Yeah, I even wrote, get in touch with Nate, him or one of the team members. So yeah, it's probably been in there 5, 6 times. People said, what was that? No, you are very well known now. Everybody's going to be wanting to get in touch with you.
Okay.
Because the access to capital team is such a great resource, and a lot of people do not know about its in existence. That's why I wanted to create an entire show that just talked about the process of getting lending. But we're a little bit over. But as a last question to you, Nate, you've been at this game for so long, through the dot-com crisis, the recession, through all this. Just in general, Nate's opinion. This is Nate's opinion. Do you see it one of the harder lending environments now? When you get up in the morning, how do you feel about the business lending world compared to so many decades that you've been engaged in this?
Well, it's definitely more challenging now, and a lot of it again is a result of what's happened the last few years.
Yeah.
Some people have taken on debt, and one of the sad things is the SBA didn't do a real good job of communicating to the people who took those SBA idle loans, and
Oh,
a lot of those loans were transferred to the Treasury for collection because the people did not, add their names or sign up for the SBA portal to learn about how they pay and when they pay their monthly payments. A lot of people were thinking, oh, that was grant money. They haven't sent me a bill or anything. But if you haven't signed up for that SBA portal,
the hardship too. The
yeah,
hardship, you're not
yeah,
taking
it's creating a lot of problems.
In fact, I'm going
A
to
lot,
talk about that next week again, is the idle hardship. Yeah, and it is. I'm seeing a lot of people with idle issues on that. I actually had it in the back of my mind. I was going to talk about. I'm having an Ask Lori Anything next week. I think I'm going to include that.
yeah, and Lori, one other thing I'll say is, according to economic news, Federal Reserve and everybody, the consumer credit has really risen and the delinquencies have risen. So all those things have impacted the lenders and made them a little shy about taking on more risk at this time. So they're holding back a little bit and trying to minimize their risk, their portfolios, and things like that. And whenever that happens, it means money is not really out there getting to the streets.
I know, and on the positive side, though, because I think this, Nate, and this is my opinion, when you don't have money available, it forces entrepreneurs to do what I call baby steps, and that creates a more sound reasoning and plan in growing their company. And a lot of times I see when there's less money available, the companies that grow up during that time period are much more solid and stable with a proven plan than the ones that get funding before they really have figured it out.
Yeah, it's a good point, Lori, because I would tell anybody, you probably want to plan your business funding. Like if you're thinking about you're gonna need some funding, even for next year, start now, get loan ready now, do all the things that we were talking about, make sure your docs are in order. You probably met with an advisor, getting that kind of advice about what it is you're gonna need. Make sure your books and records are, clean. All those things you should be doing now before you actually apply for funding. Because once you apply again, if they see that you're not ready, your financials are out of whack, it's going to take a little while longer for you to kind of get to the point where you're loan ready. So.
Well, Nate, I always enjoy talking with you. We're both old timers. You know that, Nate. We've been friends for a long time. So
Got a
it's like
stack of papers in back of me right
it's
here.
one old timer, yeah, one old timer to another. We reminisce and have a full understanding, and that's where I think being educated as an entrepreneur on how this is actually work. I know when I went into my banking career, which was later, I just wanted to learn about banks. I had no idea how things actually worked, and they're much different than you perceive from the outside. So giving a little bit of inside information. So with that, I'm going to do a shout out. Sadie's going to come back and close up our show. And as always, guys, Nate and I are going to take off, but Sadie's going to keep the chat live in case you need to grab Nate's information or anybody else's information or my information. It's going to be there. So Sadie, do you feel more equipped to understand how lending works now?
Well, I mean, what I found so fascinating is just like, current information, like where like markets have changed, like, too much restaurant. I was like, wow, I'm like, that's right. You don't think about these things, but you're like, how are things trending? And I know that this was an awesome webinar. I mean, all of them are, but it's like I had to repost everything because like I kind of do my thing like at 11:54. I'm like, let me put in the final things again. I'm like, no. I had to re-put everything all over because that's how busy the chat was.
The chat was busy. In fact, I felt like I played as a participant because I wanted you to just be able to give information. So I was over in the chat commenting. It was kind of fun playing as a participant in my own show for a change. So thank you so much, Nate. I'm going to bug you to come on again about every quarter. I know I do because we're just really lucky to get a piece of your time because I know you're quite a busy man. So thank you so much for sharing all the information. So I'm going to say, hey, for frequent flyers that are there every single week, I see you. Love you guys. Love seeing your name. Thank you for being there every week. And if you were new to the show, it's an awesome show you don't want to miss. So check in next week where we have our special episode, Ask Lori Anything. Everything's on the table, guys. I know you put me on the spot, but you ask me a question, I'll answer it live. Okay. So I will see everybody next week. Bye-bye.
Glad to be part of the show. All right. Bye-bye.